G'day everyone, my name's Michael Baragwanath. I'm the Managing Director here at Clime, joined with John Abernethy, the founder of Clime, and today we're doing The View. Now The View's normally hosted by Paul with John. Paul's away today, so I got dragged into today's video. So for those that have normally seen John and I riff, we normally go through a bunch of meandering different topics, and today we'll do the same thing, but we'll keep it more focused on economic news and events of the day. I know one thing you posted on just last night was around the budget that's been revised, and you had an interesting theory on what was likely to happen, and I think exactly what you said came to pass. So
it sort of played out because people got to recall that the budget night, March 25, was actually the 25-26 budget with a forecast for the 25 budget, okay, 24-25 budget. So in March they said that the budget would be for the June year just finished, would be a $27 billion deficit. It came in at a $10 billion underlying cash deficit, so they were wrong by $17 billion. And it's a movement of about 0.6% of GDP. It's quite significant. And it's very significant when you think that they already had 8 months in the bag, so they were only forecasting 4 months. So it's quite an issue, and there is a question mark over how Treasury comes up with these forecasts under direction or whatever duress on behalf of the government, but it certainly was a political document because it forced the Liberal Party, the opposition, to really change their play regarding the cost of future projects, and particularly energy, and particularly nuclear. And when you put out a budget which has a deep deficit in it, and you also say that the deficits going out 4 or 5 years are bad and they're structurally bad, it is a clever play by an incumbent government to stop an opposition coming forward with policy changes, then having to come up with funding based on a budget forecast which is wrong. So
how can you dare spend more money when there's less money to go around?
Correct, and that was, I said at the time in views and some public commentary that I thought there was a game going on, and it is sinister. If that's what's going on, then Treasury is not independent, and you want an independent bureaucracy advising government, the Parliament, and the people about the funding of the financial and virtually profit and loss of Australia. So that I had a caution about that. Anyway, inside the budget, we've got some adjustments, and it's very hard to find. So I'm sorry, I don't want to bore people, but there were significant movements. One of my pet hates is the unfunded liability for defined benefits. Well, it went up by $10 billion from the March estimate to the June actual. So it's.
And you've got to wonder how the hell you could be that far wrong, because that's your own expenses within your own operations, and you're out by $10 billion.
Yeah, on the estimate of the liability.
In a few months.
And it's moving every 6 or 12 months up, and it's quite a massive. And it looks to me that and I can justify it, I don't want to justify it here, I think the actual liability is $500 billion. Mm-hmm.
So you think they know what the headline figure is, and it's just trying to move towards it slowly over time.
Massaging it. And there's a hint
in increments that are equivalent to a quarter of the size of the NBN.
Yeah.
Right.
But I don't want to go into great detail because I've done this before, but one number that jumps off the page is in the deficit of $10 billion, about $15 billion was paid in pensions by the taxpayer on defined benefits, which could have been paid by the Future Fund. So arguably, we could have had a cash surplus if it wasn't for defined benefit pensions. So
which weren't paid out of the Future Fund, and the purpose of the Future Fund is to fund defined benefits.
Yeah, and they don't want to pay pensions until 2032. So, there's an issue regarding the financing of Australia. The budget is heading towards $800 billion. $800 billion, and there'll be $1 trillion by the end of this decade. It's a massive amount of money which we ask the bureaucracy and the government to spend on our behalf. And about 60 to 70% of it is taxpayer money. It's pay as you go. It's mum and dad's paying tax. So there is a legitimate concern about the level of tax and where it's going. And there are pockets in the budget. We know the NDIS is growing at an astronomical rate. That needs to be addressed. The interest bill's going up, and it's not so much that debt's going up, and debt was fairly stable last year. It's just that we're rolling debt, which was issued at 1%, into debt which has now been rolling at 4%. So there's a catch-up going on there, but nothing like what's going on in America. and what's caused their chaos.
Or are
currently.
they heading towards a shutdown?
Yeah.
Potentially.
Well, I think it's shut down now.
Yeah.
I think I woke up this
But
morning.
a real shutdown.
A real shutdown. We don't know, and again, it's a political game over there, and you probably have a view on this, but it looks to me that the Trump administration has forced this to occur. There was no negotiation to head this off, so he's caused it, and now there's some quite serious commentary by the administration about cutting back on the private service, and he's talking hundreds of thousands of jobs lost.
Yeah, and I say real shutdown because in the past it's always been technical shutdown, pay still getting rolled out, services are still being run. There was government shutdowns for weeks before they actually saw an impact.
Yeah.
Whereas I think in this case they've actually gone, no, sorry, the door's locked, go home.
Yeah, and the stock market, which is what we're concerned about, in markets, just nothing. Stock market last night, another high in America. Bond market okay. So the markets are suggesting it's going to be resolved. Let's see how this is, because Trump sees an opportunity here to force change in what is the American public service. He's got the baton. Is he going to use it aggressively? So I think the record, I could be wrong, 31 days shutdown was.
I think that's right. Month, just a month.
So only day one, and the world didn't end then. So I would suggest.
Well, I think that's why the markets didn't really respond. I mean, we've gone through this before, where it was the Republican opposition holding a Democrat, government, head of government, to account over a shutdown, and then negotiating to try and get something. This is interesting in that the shoe's on the other foot. It's a Republican who, normally they want to avoid embarrassment. Normally you don't want a government shutdown on your ledger because it's embarrassing, right? And it's the other party's fault. Whereas in this case, I think the Republicans are leaning into this and saying, no, we are going to force this because we want to make these changes. And they're going to go even harder, like you said. And there's a bit of logic to it. As cruel as this always sounds, and lots of people go up in arms around all of this, the reality is in almost all the Western countries, we've got major labour shortages in quite a lot of areas, right? And what's also happened has been there's a creeping bureaucracy across all areas of government doing the same services or often less services with more people. And so there is a bit of an argument that says, well, hang on, if you've overemployed in the public sector and it hasn't resulted in better services, are we better off actually cutting back public service? Because those people don't disappear. These are competent, intelligent people, but there are staff shortages in the real world of business.
Yeah.
And certainly the case here, I think per capita, our Australian public servants are a higher proportion of our workforce than Canada. I think New Zealand may be equal, but definitely more than Canada, the UK and the US by a long reach. And I'm not sure I'd argue that we have significantly better services for all those people. But then we have unemployment that's very low across the nation, and there's significant shortages for middle management executives, analysts. Lots of people are soaked up into public service.
Yeah, which is causing wage price pressure, and that's one thing Trump's trying to keep under control. He's trying to keep inflation under control. I did hear a commentary this morning, and my recollection was the last time we had a shutdown, it had tens of billions effect on consumption. So you've got public servants not being paid, so they defer
their own expenses.
And then there's a lost opportunity, there's a lost GDP. So what we'll have, and we've got to be careful because we analyse every week the GDP and the inflation numbers, but America for the next month or so will have slightly elevated inflation coming from tariffs, and a consumption slowdown coming from a shutdown, as it's gone to a debt limit, and I think the number's 33 trillion, 34
You're
trillion.
better than me on this.
Yeah, but they're massive numbers.
Yeah.
The budget's got to be reset. Last year's budget, I think, is going to come in close to $2 trillion deficit. Let's call it 1.9 trillion. It'll be interesting what the forecast is. And I've been reading commentary. The tariffs are collecting annualised 300 to 350 billion. We've got tax cuts coming. It doesn't look like the deficit's going to be much better than 1.5 trillion deficit for 26. So that's on top of the debt. So we're going to have debt in America going through 35 trillion.
Yeah.
The interest bill is going to be 3 to 3.5%. So we've got $1 trillion interest bill.
And the only way they're going to fix that is the same way they have before and print more money.
That's right.
Because the world continues to accept.
You've been watching The View because we've been talking about QE in 26. That's why markets, I think, are hanging together, whilst there should be quite a lot of concern, not only about the debt, but also the shutdown.
I think the other thing that's happening, though, is there's a lot more long-term investment decisions being made in the US now than there have been before. So one of the things that the administration's made very clear is if you build manufacturing capability here, if you make investments here, then you'll be excluded from these tariffs. I mean, we saw that with the, and obviously CSR,
CSL,
sorry, got smashed over this and a few other little bits and pieces. But it was, well, you know, commence building, you won't be tariffed, don't and you will, right? And so that forces long-term thinking. If you're an industrialist or a large, you know, executive, you're sitting there going, well, okay, in what universe would it make sense for me to manufacture in the US? Whereas before that was not a conversation. So it's forcing businesses to think a bit longer term, because construction, manufacturing and you know, localising production is complicated long-term thinking stuff. That's not a, let's build a factory here tomorrow. That's a, okay, well, I'm going to have to think of everything. And I've done regional developments before. You've got to think about where the staff are going to live, how you're going to recruit them, why they're going to move to this location, you know, how they're going to get a meal. You've got to think through all this logistics. And if you're, you know, NVIDIA or Apple or, you know, Google and Microsoft, you're sitting there going, okay, I'm going to have bigger data centres in the US. Where are these people going to live? There's all these other flow-on conversations.
Look, we'll get onto Australia shortly on the housing market, but the point I'm hearing is that there's no shortage of capital. So there's plenty of capital to build manufacturing industrial sites in America.
I think if
but
anything,
the skill of the labour.
Yes, that's a big problem. If anything, there's too much capital that's not been able to find a home, because you know, so much is flowing into venture capital, and then that's tightened up off the back of COVID. A lot of small, you know, early stage businesses now really struggle to get access to capital, but there's still a lot of money floating around, and it's just, where does it go?
And it's the skilled labour force which America seems to have drifted away from. As we know, very much services, very similar to Australia. We are abundant in services employment. So when you have a requirement, whether it's clean energy or building more houses or infrastructure, no shortage of capital, same thing as America, but we've got a shortage of skilled employees, which is the immigration discussion, which, you know, immigration's fine, but we've got to get skilled people here.
Well, the other thing that we're not having conversation on is the difference between permanent and temporary migration. And this is one thing that we can say, and there'll be a bunch of unionists that will hate me saying this, but the reality is, if we brought in temporary workforces to construct things and then sent them home, we can have our cake and eat it too. We can bring in labour forces, construct housing, take them back home again. That's not going to create a long-term imposition on the population shift. It's not going to create moral changes. It's not going to create all these other concerns that people have. Valid or not, they have those concerns. But, you know, you look at large states that have had to industrialise or commercialise quickly, Saudi Arabia, most of the Middle East, as in the modern Middle East, Bahrain and UAE and all the rest of it, they didn't have the population or the labour force. They didn't allow permanent migration, but they did a lot of temporary migration. They brought entire building teams in to construct.
Yeah, you're right. The unions do have an ability to stop this occurring. You look in fruit picking, you know, we get people coming in from the South Pacific and they come in and go home. You know, it's not a unionised
that's more helping these poor oppressed people though, rather than
a bit
lifting
of both,
up their opportunities.
But I mean, we will be bringing in, we need people to come in and build housing and infrastructure. I mean, and as you say, the unions won't be happy about it. So there is a block there. But it goes to what I keep on saying, Australia needs a plan, which from a plan and a target creates a policy, and then you report on how you're going against your targets.
Well, not so well, I think, we'll get to housing, but you know, this multi-billion-dollar housing plan has, I think, constructed the equivalent of 8 Sydney houses since the policy was founded. So the idea of setting aside this capital, using the earnings from the capital to build the houses, equivalent to 8 Sydney houses have so far been built.
Yeah, and you can see the policy which is being developed, the 5% deposit and the mortgage insurance taken on by the government. We're creating finance to buy homes. We're not creating the supply solution.
No.
And that's interesting. It's very much a political response.
Good for bank shares, though.
Yeah, should be. It creates asset growth for banks. But it's putting a burden on entrants. So, you know, there's a commentary, we don't need a 20% deposit, so you only need a 5% deposit, so we're saving young couples 150, 200 grand in Sydney. Well, are you saving them? They're taking on 95% debt. They're going from, say, a profile where they might pay debt off in 15 or 20 years, now they've got to say 30 years plus. So it's false economy. You're not saving these people anything, you're actually putting a burden on them, and you're supporting the excesses in the property market, which politicians love to talk about. They think wealth is created by property prices going up. it actually creates an underclass, and it actually creates for a future generation a financial trap. And
Well, the likely reality here, and this is the funny thing is that what I love in markets is that almost always someone else has done it before, right? So you can just go, hang on a second, has any other economy tried experimenting with making lending easier? That was the US with Freddie Mac and Freddie Mae, right? And what was the whole idea? It was to help get people into housing, lower the lending standards.
When was that?
Lower
was
the deposit.
Before the GFC,
It was just a little bit before the GFC. I think it's actually probably the primary reason for the GFC.
Yeah, and I've always said Australia, we didn't have a GFC. We went through a financial crisis worldwide, but we didn't really have one. A lot of it was self-inflicted wounds by banks panicking, and probably there was issues around St George Bank and Macquarie, but that was solved. So we didn't learn anything.
Look, I think you're
I know
right.
you're going to go regulations, but I'm going in terms of the housing market. We didn't.
No, you're right.
The policy. We learned a bit about financial controls and regulation, but the housing policy of Australia, nothing was learned.
We never fixed it. My argument to the GFC is that Australia actually had its GFC in the 90s when two of our major banks nearly collapsed and we had to bail them out. We created Twin Peaks, we had APRA. And I think the other part, and I've said this a few times as well, all of these they've all been well-intentioned, but the outcome's been a longer-term disaster. So we've put all these capital requirements on banks, which now mean that banks really only lend to homeowners, and they don't care about commercial lending, and they don't care about construction lending, and they don't care about any of the other elements of non-house finance that lead into houses, right? Large land subdivisions. There's an issue that's been talked about this week around private credit and the rise of private credit, and it's largely a failure of banks to lend to that same sector. And the fact that those developments still need to occur, they're just now willing to pay a higher price for it.
Yeah.
But that distortion has flowed into the same issue with housing. So we have this interesting dilemma as fund managers with bank stocks, because every fund manager will sit there and say they're overvalued. But if you go and track housing prices in New South Wales against bank stock values, the line correlates like that. It's 1 for 1.
Yeah.
So you sit there with a policy that says, well, it's 5% deposit. Okay, how much further overvalued will the banks get based on our normal fundamentals versus what the government's actually doing?
What's the assessment of risk? And the market is comfortable of the risk profile of banks lending against security of housing. That risk profile will change. If your LVRs are averaging 70%, yes, it's low risk. But as you push the LVRs up towards 90, 95, it doesn't take much of a price shock to cause an issue. So the risk is actually going up. So to counter the argument, and what we're thinking about in owning banks. So there's the so what, how we finish, So what are we saying here? If you really deeply think about it, and taking the GFC, taking Freddie Mae and Fannie Mae, Freddie Mac, what happened?
Names ever for institutions.
Well, what happened? The government, the Treasury had to take them over.
They had to bail them out.
Yeah, so I'm not saying this is going to happen, but this is one scenario which we may have to think about, that housing pricing gets so acutely expensive and that latecomers to that market are so heavily geared, supported by government. There's a slight downturn and it brings more people into potential security default, and the government has to come in and say, we'll take all those loans off the banking sector. The buyer of last resort.
It's an unhappy situation for young families. That's the reality, because you would sit there as a logical person going, I should not participate in borrowing with a 5% deposit. That's like a logical person would go, this is dangerous, this is going to blow up, I could end up being stuck.
Especially if you're in your 30s, because if you end up with a 30-year loan, are you going to retire and have no mortgage?
More and more people are retiring with a mortgage. This happened in the UK. So again, we look around the world. The UK market had this idea of never actually pay the principal, just pay the interest, invest the difference. And so the idea was you just keep your mortgage there and invest in the stock market. Now, the UK stock market's quite different to Australia and the US. And when it fell apart, you had a whole stack of people, that tens of thousands, hundreds of thousands, with massive mortgages, no principal repaid, housing prices that gone nowhere, and the stock market that had fallen. And they'd never actually, because this big strategy pushed by the banks for years was never pay your house off.
Correct.
So, but the challenge for that, and I see this on Reddit and all the rest of it all the time, is that all these people that go, the house market, this time for sure it'll crash, it goes up again. And they just get left further and further behind because there is no entry level point. There's no basic one bedroom, simple something that gets people started. The standards are so high on everything that to get started means coming up with $1 million.
Yeah.
So you go, now you only need to come up with 50 grand.
My view is that the government, we were talking the other day in the office, is this 5% the last card in the pack? You know, there might be other tricks they come up with where they say, look, no deposit, and we'll put up the 10%, we'll put a surcharge on you. Who knows? We're getting near the end of the cards they can play, you know.
Oh, the next one is build to rent, which they've started with, but it'll be pushing the industry funds to build assets for people to rent.
Yeah, on a infrastructure type bond return of, you know, bond plus 1 or 2%, and then all of a sudden you see superannuation returns come back to reality. So it all goes to the point, you know, there's been an article written by the AMP recently, you know, about returns from super longer term are probably going to plateau and start coming down again because we had this great bounce coming out of COVID and very low interest rates and inflation-induced returns. You know, inflation pushed up returns. So, you know, our job, I guess, is to understand this macro cycle and, you know, adjust asset allocation and start thinking about what's a sustainable return without taking on too much risk. So we're thinking about it, and I guess we should close off there. But we will be going around Australia in the next few weeks. So watch your emails and watch your website. I think we're Brisbane the week after next, and then we're in...
We're going Gold Coast, Brisbane, Sydney, Melbourne, Adelaide, not in this order, so we'll do check Perth. I think we're in every capital city.
Yeah.
So we just got to figure out a way to get to Darwin. So we need people in Darwin to watch, because I used to get up there all the time, love Darwin. Yeah. And we need people in Tassie to watch and call us down to Tassie, because my wife's from down there and it's a beautiful place.
Yeah. So watch out for that, and we look forward to seeing you.
Yeah, brilliant. All right.
See you next time.
Thank you. So thanks, everyone. And if you've got feedback, please comment. We do read the comments. Occasionally I'll reply to your comments as well. So thanks for your time, and hopefully we'll see you in person. Thanks a lot.